Stop what you are doing. Close every other tab. Turn off the notifications. What I'm about to show you is the biggest financial fraud happening in real time. It is happening right now. It is happening in plain sight. And almost nobody is talking about it. Look at your screen. Look at the silver price. It says $74, maybe $75. It shows a nice green candle. It shows normal trading activity. It looks legitimate. It looks real. But it is not real. It is a crime scene dressed up as a marketplace. You are looking at a lie. You are looking at a number that has been manufactured by algorithms, defended by trillion-dollar banks, and broadcast to the world as if it were the truth. But 5,000 miles away, in the factories of Shenzhen, in the vaults of Shanghai, in the dealing rooms of Hong Kong, a completely different number exists. That number is $100. Let me say that again so it burns into your memory. The physical silver market in China is transacting at $100 per ounce. The paper silver market in New York is showing $74. There is a $26 gap between the lie and the truth. This gap is not a glitch. It is not a temporary anomaly. It is the visible evidence of a fraud that has been running for decades. And right now, that fraud is collapsing. This is the story of two prices. One price lives on computer screens. It is generated by futures contracts, by naked short selling, by leveraged paper bets that have no connection to physical metal. This price serves the banks. It protects their short positions. It keeps the public asleep. The other price lives in the real world. It is the price at which a solar panel manufacturer in Guangzhou pays for the silver paste that coats the cells. It is the price at which a vault in Shanghai accepts delivery of 1,000-ounce bars. It is the price at which actual atoms change hands between actual buyers and actual sellers. For 40 years, these two prices moved together. The paper market set the benchmark, the physical market followed. But something has broken. The physical market has disconnected. It is running away from the paper market at a speed we have never seen. And the gap between them is screaming one message: the fraud is ending. In this emergency investigation, we are going to dissect this $26 fraud. We are going to show you exactly how the paper price is manufactured. We are going to prove that the New York number is a fiction maintained by entities that are short more silver than exists in all the vaults of the Western world. We are going to reveal the desperation trades happening in Shanghai as industrial giants pay any price to secure metal. And we are going to explain why the New York price has a mathematical destiny to rise $26 in a violent repricing event. You are not watching a market. You are watching a confession. The $26 gap is the banks admitting they cannot control the physical world. They can control pixels, they can control algorithms, they can control CNBC, but they cannot control a factory manager in China who needs silver to keep his production line running. They cannot control 1 billion citizens looking for a safe haven from a collapsing property market. They cannot control the laws of supply and demand when supply has vanished. Here's the first piece of evidence. The Shanghai Gold Exchange publishes a daily fixed price for silver. That price, as of this recording, is trading at a premium that converts to roughly $78 in dollar terms. But that is the exchange price. The street price, the price that dealers are actually charging for immediate physical delivery, has exploded. Reports from precious metals traders on the ground in China confirm that industrial buyers are paying close to $100 to get metal today. Not next month, not next quarter, today. Why would anyone pay $100 when the screen says $74? Because the screen is lying. Because if you call up the COMEX and ask for 10,000 ounces of physical silver delivered tomorrow, you will not get it. They will offer you cash settlement. They will roll your contract. They will do anything to avoid giving you actual metal. But in Shanghai, if you pay $100, you get the metal. In one market, you get a promise. In another market, you get atoms. The atoms are worth more than the promise. That is why the price is higher. Do you understand the magnitude of what I am telling you? The world's largest consumer of silver is paying 35% more than the official price. This is not a small discrepancy. This is not a normal premium. In professional trading circles, this is called a broken market. When two markets diverge by more than a few percent, arbitrage traders step in and close the gap. But the gap is not closing, it is widening. This tells us that the arbitrage mechanism is broken. It tells us that there is not enough physical metal in the West to exploit the spread. It tells us that the vaults have been drained, the cupboards are bare, and the only thing holding the New York price at $74 is pure financial engineering. Paper contracts, naked shorts, and faith. Faith is evaporating. The industrial buyers know the truth. The Chinese government knows the truth. The bullion banks know the truth. Soon, the retail investor will know the truth. And when the masses realize that the price on their phone is a hallucination, when they try to convert their paper claims into physical metal and discover there is none, the panic will begin. In the next section, we are going to look inside the machine. We are going to explain exactly how the New York price is manufactured. We are going to name the entities running the suppression scheme, and we are going to show you the mathematical proof that they are losing control. The fraud is unraveling in real time. The evidence is overwhelming, and by the end of this investigation, you will never look at the silver price the same way again. Stay with me. We are just getting started. Now that you understand the gap exists, you need to understand how it was created. The $74 price in New York is not an accident. It is not the result of free market forces. It is the output of a price-setting machine that has been engineered, maintained, and defended by the largest banks on Wall Street. To expose the fraud, we must open the machine and look at its gears. The COMEX is the center of the scheme. It stands for Commodity Exchange. It is owned by the CME Group, and it is where the world's silver price is officially determined. Every day, traders buy and sell futures contracts. Each contract represents 5,000 ounces of silver. The total open interest, the number of contracts outstanding, currently exceeds 150,000 contracts. That is 750 million ounces of paper silver being traded. Here's the first problem. The total registered inventory in the COMEX vaults, the actual physical silver available for delivery, is approximately 30 million ounces. Do the math. 750 million ounces of paper claims, 30 million ounces of physical metal. There are 25 paper claims for every real ounce. This is a 25-to-1 leverage ratio. In any other context, we would call this a Ponzi scheme. In the commodities market, we call it normal. How does this suppression work in practice? The bullion banks, primarily JP Morgan, Bank of America, HSBC, and Citibank, hold massive short positions. They sell contracts they do not intend to deliver. They are betting that the price will go down. But more importantly, by constantly selling, they create artificial supply. Every time the price tries to rise, an algorithm triggers more selling. The bots do not care about profit. They care about keeping the price contained. Why would banks want to suppress the price of silver? Because silver is the canary in the coal mine. Silver is a monetary metal. For 5,000 years, it was money. If silver rises, it signals that the dollar is dying. It signals that inflation is out of control. It signals that the $36 trillion debt pyramid is unstable. The banks are not just trading silver, they are defending the credibility of the entire financial system. A rising silver price is a vote of no confidence in fiat currency, so they suppress it. The mechanics are elegant in their criminality. During periods of low liquidity, typically the overnight session or early morning, the algorithms dump thousands of contracts onto the market in seconds. This is called the waterfall attack. It crashes the price, triggers stop losses, and creates fear. Retail traders panic and sell. The banks cover their shorts at lower prices. Then they reload and do it again. This has worked for decades, but it only works when there is enough physical metal to satisfy the occasional buyer who actually wants delivery. The paper game depends on the illusion that the metal exists. As long as nobody calls the bluff, the game continues. But China is calling the bluff. China is demanding metal at any price, and the bluff is failing. Let me show you the proof. Look at the registered inventory at the COMEX over the past 3 years. In early 2021, the registered silver inventory was over 150 million ounces. Today, it is under 30 million ounces. That is an 80% decline. The vaults have hemorrhaged metal. It has been flowing east, ounce by ounce, bar by bar, container by container. The physical is leaving. Only the paper remains. Now look at the eligible inventory. This is metal that is stored in COMEX vaults but not available for delivery. It belongs to private holders who have not registered it for sale. In theory, this inventory could become registered if the price rises enough. But in practice, the holders are not selling. They see the same charts we see. They know the shortage is real. So the eligible inventory sits there, tantalizing the shorts, forever out of reach. The banks are trying to replace physical control with paper control. They are issuing more contracts to create the illusion of supply. But every contract they issue is a future liability. If a buyer stands for delivery, the bank must either find the metal or default. And finding the metal is becoming impossible because China is hoovering up every available ounce. Here is the smoking gun. The COMEX delivery reports show that in recent months, the number of contracts standing for delivery has surged. Traders are no longer rolling their contracts into the next month. They are demanding metal, and the metal is not there. The banks are scrambling. They are paying premiums to convince holders to relinquish their silver. They are borrowing from other vaults. They are delaying deliveries. They are doing everything except admitting that the inventory is gone. The $74 price is maintained by these paper games. But paper cannot build a solar panel. Paper cannot coat an electrical contact. Paper cannot store wealth for a Chinese grandmother. At some point, the paper price must reconcile with the physical price, and that reconciliation is happening now. The $100 price in China is the market screaming that the reconciliation is here. The paper price is lagging because the banks are fighting. But they are fighting gravity. and gravity always wins. In the next section, we are going to cross the Pacific. We are going to go inside the Chinese market and understand why they are willing to pay $100. We are going to meet the buyers who are stripping the world of silver. And we are going to explain why their demand is not a bubble. It is a rational response to a world that is running out of atoms. The East has awakened, the West is asleep. And the $26 gap is the alarm clock that nobody in New York wants to hear. Stay tuned. Let us leave New York. Let us leave the algorithms and the paper contracts and the manipulated screens. Let us travel 5,000 miles east to where silver is not a ticker symbol but a strategic resource. Let us understand why Chinese buyers are paying $100 for something that New York says is worth $74. The answer is not speculation. The answer is survival. China dominates the global solar panel industry. They manufacture 80% of the world's photovoltaic cells. Every single one of those cells requires silver. Silver paste is applied to the silicon wafers to conduct electricity. Without silver, the cells do not work. Without cells, the panels do not generate power. Without power, the green energy revolution stops. The Chinese government has mandated massive solar expansion. They are installing gigawatts of capacity every month. The factory floors are running 24 hours a day. And every hour they consume silver, not paper silver, physical silver, the kind you can hold in your hand, the kind that is disappearing from Western vaults and reappearing in Asian factories. A gigafactory manager does not care about the COMEX price. He cares about keeping his production line running. If he runs out of silver paste, his factory shuts down. The cost of shutdown is millions of dollars per day. So when his supplier quotes him $100 an ounce, he does not argue. He pays, because $100 per ounce is cheap compared to the cost of failure. This is what economists call inelastic demand. The buyer must have the product regardless of price. If the price doubles, demand does not fall. If the price triples, demand does not fall. The factory must run. The solar panels must ship. The government targets must be met. And silver is the bottleneck, so the price explodes. But industrial demand is only half the story. The other half is citizen demand. The Chinese population is experiencing a financial crisis. Their property market has collapsed. Evergrande, Country Garden, and dozens of developers have defaulted. Trillions of dollars of household wealth have evaporated. The stock market is struggling. The currency is under pressure, and the people are scared. When Chinese citizens get scared, they do not buy bonds. They do not trust paper. They buy gold and silver. This is a cultural tradition stretching back millennia. Metal is safety. Metal is wealth that cannot be defaulted. Metal is the hedge against a government that prints money. And right now, there is a stampede into precious metals across China. The retail demand is layering on top of the industrial demand. Factories need silver to produce. Citizens need silver to protect. Both are bidding at the same time. Both are draining the same limited supply. The result is a demand surge, unlike anything the market has seen in a generation. Shanghai is the gateway. The Shanghai Gold Exchange is the largest physical precious metals exchange in the world. Unlike the COMEX, which is primarily a paper market, the Shanghai Exchange is a delivery market. When you buy silver on the Shanghai Exchange, you typically take the metal. This creates constant physical demand, and when that demand exceeds supply, the price gap's higher. The reports from Shanghai are alarming for the bears. The exchange inventory has been falling. The deliveries have been rising. The premiums charged above the fixed price have expanded to levels not seen since the 2011 mania. And the word from dealers on the ground is clear. There's no silver left at the official price. If you want metal today, you pay $100. Take it or leave it. Now consider this strategic dimension. China knows a war over Taiwan is possible. They know that in a conflict, sea lanes could close, supply chains could sever. They would be cut off from Western commodities, so they are stockpiling. Not just silver, gold, copper, rare earths, oil. Every strategic resource is being hoarded. The Chinese government has been buying gold at a record pace. The same logic applies to silver. Silver is a military metal. It is used in missiles, in radar systems, in communication equipment, in every piece of advanced military hardware. If you are preparing for conflict, you do not want to depend on your enemy for silver. You secure your own supply, you pay whatever it takes, and if that price is $100 while New York says $74, you shrug and pay $100 because the alternative is running out during a war. This is the reality that the Western banks are fighting. They are not fighting speculators. They are not fighting retail stackers. They are fighting the industrial machine of the world's second largest economy. They are fighting a billion citizens, protecting their savings. They are fighting a government preparing for geopolitical confrontation. And they are fighting with paper against a tide of physical demand. The $100 price is not a bubble. It is not irrational exuberance. It is the rational price for a scarce resource in a market where scarcity has arrived. The $74 price is the irrational one. It is the fantasy price that pretends supply is infinite. It is the price that ignores depleted vaults and soaring demand. It is the lie that is about to be corrected. In the next section, we are going to return to New York. We are going to look at the banks that are trapped on the wrong side of this trade. We are going to examine their short positions, their exposure, their desperate attempts to escape. And we are going to explain why some of the biggest names in finance are about to become casualties of the silver squeeze. The hunters have become the hunted, the shorts are trapped. And the $26 gap is their prison cell. Let us look inside. The banks have a problem. Actually, they have 750 million problems. That is how many ounces of paper silver they have sold short on the COMEX. And every single one of those ounces is becoming more expensive to cover as the physical price in China screams toward $100. Let me explain the short position. When a bank sells a futures contract, they are promising to deliver silver at a certain price on a certain date. If the price goes up, the value of that promise goes down. The bank loses money. If the price goes up by $26, the loss is $26 per ounce. Multiply that by millions of ounces, and you get losses that would bankrupt most companies. The concentrated short position in silver is legendary. For years, a small group of banks has held a short position that exceeds the annual global mine production. This is documented in the CFTC's Commitment of Traders report. The 4 largest commercial traders hold over 40% of the entire short interest. In any other market, this would trigger antitrust investigations. In silver, it is tolerated because the banks are seen as market makers providing liquidity. But liquidity provision has limits. A market maker is supposed to be neutral. They buy from sellers and sell to buyers, profiting from the spread. They are not supposed to hold massive directional bets. When a market maker is short 200 million ounces and the price rises $26, they are not providing liquidity. They are bleeding capital. Right now, the banks are staring at screens that show $74 in New York and $100 in Shanghai. Their mark-to-market losses are staggering. Even using the suppressed COMEX price, they are underwater on positions accumulated at $20, $25, $30 over the past decade. They have been adding to shorts every time the price rose, confident they could smash it back down. But this time, the smash is not working. Why is it not working? Because they are fighting a physical vacuum. You cannot suppress a price when there is no supply. You cannot manufacture metal with a keyboard. The algorithms can print paper contracts all day long, but they cannot print a single ounce of silver. And when the industrial buyers in China demand atoms, not contracts, the game is over. The banks have tried everything. They have raised margin requirements to shake out speculators. They have released bearish research reports to scare retail. They have coordinated waterfall attacks during illiquid hours. Every tool in the manipulation playbook has been deployed, and still the price creeps higher, and still the Shanghai premium expands. Here's the nightmare scenario for the shorts: a delivery squeeze. Under COMEX rules, any holder of a futures contract can demand physical delivery during the delivery month. If enough holders stand for delivery, the exchange must provide the metal. But if the metal is not there, the exchange faces default. To avoid default, the price must rise high enough to convince holders to sell their claims for cash. This is called a short squeeze. The conditions for a squeeze are perfect. Registered inventory is at historic lows. Open interest is near historic highs. The Shanghai premium creates an incentive for anyone taking delivery to immediately ship the metal east for a $26 profit. Every rational actor should be demanding delivery and exporting. This creates a death spiral for the vaults. Some of the shorts cannot exit. Their positions are so large that any attempt to cover would send the price parabolic. They are trapped in a burning building with a door the size of a keyhole. They can see the exit, but they cannot fit through it. So they wait, hoping for a miracle, hoping that demand collapses, hoping that a new mine comes online, hoping that China suddenly decides it does not need silver anymore. None of these miracles are coming. Demand is accelerating. Mines are depleting. China is intensifying its stockpiling. The only escape for the shorts is to cover at higher prices. And when they cover, they become buyers. Their buying pushes the price higher, which triggers more short covering, which pushes the price higher still. This is the feedback loop that destroys short sellers. It is starting now. We are seeing signs in the open interest data. When the price rises and open interest falls simultaneously, it means shorts are covering. They are buying back their positions. They are admitting defeat. They are fleeing the trade. This capitulation is happening in slow motion right now, but slow motion can become fast motion in seconds. One margin call, one bank deciding to survive at the expense of others, and we get a flash squeeze that adds $10 or $20 in a single session. The Widowmaker has been activated. In finance, a Widowmaker is a trade that looks smart but destroys anyone who touches it. Shorting silver at $74 when the physical price is $100 is the definition of a Widowmaker. The risk reward is insane. You risk $26 to the upside to make maybe $5 to the downside. No rational trader takes this bet. The only ones still short are the trapped, the stubborn, and the suicidal. In the next section, we are going to trace the metal. We are going to follow the bars as they leave London and New York and travel to Shanghai. We are going to quantify the arbitrage drain. And we are going to calculate when the Western vaults run completely dry. The physical is leaving, the paper is staying, and the day of reckoning is approaching at freight speed. Stay with me. The story is reaching its climax. Every day planes are taking off from London, Zurich, and New York. They are not carrying passengers. They are carrying silver, 1,000-ounce bars, packed in crates, insured for millions, flying 12 hours to Shanghai. This is the arbitrage trade. And it is draining the West at a speed that the markets have never witnessed. Let us do the math. You are a global bullion dealer. You can buy silver in New York at $74. You can sell it in Shanghai at $100. The cost of freight and insurance is perhaps $1. The profit is $25 per ounce. On a 1,000-ounce bar, that is $25,000 profit. Risk-free. Guaranteed. No analysis required. Buy here. Sell there. Collect the spread. This is not speculation. This is arbitrage. It is the most basic trading strategy in finance. When the same asset trades at different prices in different markets, you buy the cheap one and sell the expensive one. The gap closes. Equilibrium is restored. This is how efficient markets are supposed to work, but the gap is not closing. Instead, it is widening. This tells us something terrifying. There's not enough physical metal in the West to exploit the arbitrage. Every available bar is already allocated. Every refinery is running at capacity. Every logistics chain is maxed out. And still, the demand from China exceeds the supply from the West, so the premium grows. Think about what this means. At $25 profit per ounce, there should be a stampede to buy Western silver and ship it east. Every bullion dealer on the planet should be doing this trade, and they are trying. But they cannot find metal. They call the COMEX. The vaults say the metal is spoken for. They call the LBMA. The same story. They call the refiners. Backlogged for months, the supply chain is empty, the cupboard is bare. This is the physical drain in action. The metal is leaving the West, and it is not coming back. It is being consumed in solar panels. It is being stored in Chinese vaults. It is being converted into wealth preservation for 1 billion citizens. The West is exporting its monetary reserves to the East in exchange for paper profits. The numbers are stark. London used to hold over 1 billion ounces of silver in its vaults. Today, estimates suggest that number has fallen to under 500 million ounces. Half the stockpile is gone. The COMEX registered inventory has dropped 80% in 3 years. The SLV ETF, which claims to hold physical silver backing its shares, has seen its holdings decline even as the share price rises. Where's the metal going? East. Always east. At the current rate of drain, the Western vaults will hit zero within months, not years, months. When registered inventory at the COMEX hits zero, the exchange faces a choice. They can default on delivery obligations, or they can let the price rise to whatever level is necessary to attract metal back from the East. Default or moon. There is no third option. The arbitrage vacuum is creating a sucking sound that every trader can hear. It is the sound of physical demand overwhelming paper supply. It is the sound of reality asserting itself over fiction. It is the sound of a 40-year price suppression scheme collapsing under the weight of its own contradictions. Here is the key insight. The New York price is not just low. It is wrong. It is a number that makes the arbitrage trade profitable. In an efficient market, the arbitrage trade should not exist. The prices should converge. The fact that you can make $25 per ounce shipping silver to China proves that the New York price is suppressed. It proves that artificial forces are holding it below equilibrium. It proves the fraud. The market is trying to correct. Every bar that flows east is a correction. Every dealer who quotes $100 in Shanghai is a correction. The correction is happening in physical space while the paper market lags behind. But the lag cannot last forever. Eventually, the COMEX will run out of metal. Eventually, the longs will demand delivery and find nothing. Eventually, the paper price will gap up to meet the physical price. That gap up could be 10, it could be 26, it could be more if panic sets in. We are watching the final days of cheap silver. The metal is being vacuumed out of the system. The arbitrage bots are working overtime. The logistics companies are booked solid. Every plane, every ship, every truck that can carry silver is carrying silver. And it is all going to Asia. When the drain is complete, when the last bar leaves the Western vaults, the price will reset. It will not rise gradually. It will not climb 1% per day. It will gap. It will jump $10 or $20 overnight. It will break the charts. It will trigger margin calls. It will force the shorts to cover. And it will confirm what Shanghai has been telling us all along. Silver is worth $100. In the final section, we are going to look at the end game. We are going to predict what happens when the gap closes. We are going to discuss what this means for you, the individual investor. And we are going to give you the action plan for the repricing event. The fraud is ending. The truth is emerging. And you are positioned on the right side of history. Let us finish this story together. We have arrived at the final chapter. We have seen the fraud. We have understood the mechanism. We have traveled to China to witness the hunger. We have watched the banks bleed. We have traced the metal as it drained from west to east. Now we must answer the question that matters most. What happens next? The answer is convergence. The two prices must become one. The physical price and the paper price must meet. They cannot stay separated by $26 forever. The laws of economics do not permit it. The laws of physics do not permit it. Something has to break. Either the Shanghai price must fall to $74 or the New York price must rise to $100. There is no in-between. And since the Shanghai price is based on real demand from real buyers paying real money for real metal, and the New York price is based on leveraged paper bets backed by depleted vaults, we know which price is true. The truth is $100. The lie is $74. The lie is about to die. The convergence will not be gradual, it will be violent. Market disconnections do not heal slowly, they snap. Remember the Swiss franc depeg in 2015? One day the peg existed, the next day it was gone. The franc moved 30% in minutes. Traders were wiped out. The market gapped through every stop loss in existence. This is what happens when artificial price controls fail. Silver's artificial price control is the paper short position on the COMEX. It has been holding back the tide for 40 years. But the dam is cracking. The inventory is draining. The shorts are covering. The physical market is screaming that the price is too low. When the dam breaks, the flood will be biblical. My expectation is this. Within weeks, not months, we will see silver break $80 in New York. It will be the first psychological barrier to fall. Then $85 as the momentum traders pile in. Then $90 as the mainstream media starts covering the story. Then $100 as the paper price finally admits what Shanghai has been saying all along. This is not a decade-long journey. This is a sprint. The market is catching up to reality in real time. What does this mean for you? It means that every ounce of physical silver you hold is worth more than your screen says. It means the $74 price is an entry point, not a fair value. It means you're buying $100 bills for $74. This is a gift from the manipulators. They are giving you one last chance to stack before the reset. But you must understand how to play this correctly. Do not sell your silver for dollars at 80. Do not sell at 90. Do not even sell at $100. Because what would you buy with those dollars? More dollars? The same dollars that the government is printing by the trillion? The same dollars that are backed by $36 trillion in debt? That is a losing trade. You are swapping a scarce, strategic asset for infinite paper confetti. The smart money uses the ratio trade. When silver peaks relative to gold, when the gold to silver ratio falls to 30 or 20 or 15, you swap your silver for gold. You never touch dollars. You stay in the hard asset universe. You convert the volatile silver into the stable gold. And when the ratio swings back the other way, you convert the gold back to silver. This is how dynastic wealth is preserved across generations. This is the secret the banks do not want you to know. Right now, the ratio is approximately 60 to 1. It takes 60 ounces of silver to buy 1 ounce of gold. This is still cheap for silver. In 1980, the ratio hit 17. In 2011, it hit 30. Geologically, the ratio should be 8. So even at $100 silver, the ratio would be around 45. Silver would still be undervalued. The real opportunity comes when silver overshoots, when the ratio collapses to 15 or lower, and you convert your silver into gold at the peak of the mania. This is your roadmap. Hold at 60, monitor at 40, alert at 30, execute at 15. When you can buy an ounce of gold with 15 ounces of silver, you make the swap. You lock in your gains in gold. You wait for the next cycle, and you do it again. The price fraud is ending. The $26 gap between New York and Shanghai is the evidence of its death. The paper market lied. The physical market told the truth. And now the truth is asserting itself. The vaults are draining, the banks are covering, the factories are hoarding, the citizens are stacking. The convergence is inevitable. You saw this before the masses. You understood the fraud while others trusted the screen. You accumulated metal while others accumulated paper. And now you're positioned to benefit from the greatest repricing event in the history of precious metals. The East set the price at $100. The West is catching up. The transfer of wealth is not coming. It is happening now. And you are on the right side. This is the story of the $26 fraud. This is the story of its death. And this is the story of your victory. Stay strong. Stay stacked. The reckoning is here.